The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A rally in financials pushing the S&P to a fresh record high as bank executives jawbone that soft landing narrative. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
I'm Alex Steele. Good to see you, by the way.
Thank you. And you know, I lost count of how many record highs we're at, and I said the first thing I'm going to ask Alex Steele today is what number are we at?
45. 45 record closes for the S&P so far this year. We close out around these levels. It looks like that's a pretty solid bet. Looking at 58.15 here within the S&P, and the soups are pretty good here. You look at up for 5 straight weeks when it comes to the S&P. Mid caps also hitting a record as well. Mid cap index up 1%. And I know Dow Jones, like it or not, but that's also at another record high, Romaine.
Ooh, a cardinal sin. You put the Dow Jones Industrial Average on the board. Oh my gosh. All right. Well, anyway, it is a good look at the broad markets that are poised for a 5th straight week of gains, but this time powered by a tech stock rally that we had early in the week and a bank stock rally to end it. It's a powerful combo that really vaults the S&P 500 to another record high here on the eve of the 2-year anniversary of the start of this bull market, a bull market that has added 60+%. Excuse me, these numbers are so big, I'm getting verklempt. And almost 90% to the NASDAQ 100 here. Keep an eye on that space here because we talk about how much further this has to go, and that rally in financials could be key to keeping it going. The KBW Bank Index today outperforming the broader S&P by the widest since at least mid-July, and that's on the back of better than expected earnings from JP Morgan and Wells Fargo, and more importantly, better than expected economic commentary from their executives.
Overall, customers in our consumer businesses continue to hold up relatively well, benefiting from a strong labor market and wage growth. Consumer charge-offs declined from the second quarter, driven by lower losses in our credit card portfolio, while our other consumer portfolios continue to perform well, reflecting the benefit of prior credit tightening actions. We continue to look for changes in consumer health, but we have not seen meaningful changes in trends when looking at delinquency statistics across our consumer credit portfolios.
And I promise you guys, this is way more exciting than Charlie Scharf made it sound. We're going to dive a little bit deeper into Wells Fargo in a second. That broader investment sentiment around the broader economic sentiment, that's continuing to support that soft landing narrative. But just a reminder, this market is not a monolith, never has been. Apple, Netflix, Salesforce, all moving lower today, and Tesla, who we're going to talk about a little bit later. That Cybercab unveiled last night was viewed as all hat, no cattle by investors. Tesla, the biggest decliner in the S&P and the NASDAQ, Alex, on the day and on the week.
That's Tron. It looks like Tron. I would write it if it was Tron. I'm just saying. I think it's worth taking a moment and looking at the KBW Bank Index. I know that Romaine was just talking about it and how it's outperforming the S&P, but it's also at its highest level since 2022, back in April. So I think it's worth taking a moment and the round trip where we've been. I mean, here you have the big decline back when we had the SVB crisis in the first quarter of 2023, and then a slow and steady rally and really off the lows that we saw back at the end of last year, and the continued climb. And here we are, highest level that we've seen in about 2 years. And it really sets the bar high, you would think, Romaine, for the other guys like Goldman, Morgan Stanley in particular, because you had JP Morgan investment banking revenue coming in and equities trading coming in so strong. But those gains really leading, those cyclicals really leading.
Absolutely here. And I know it's still early in the earnings cycle, particularly when it comes to banks. But some of the news we've gotten has been positive, particularly when it comes to flows, whether it's deposits or flows going into ETFs. Blackrock a little bit earlier, the world's largest asset manager reported results, pulling in a record $221 billion of total client cash and pushing its assets to an all-time high of $11.5 trillion. Emily Graffeo here at Bloomberg News joining us right now for some of the big takeaways from BlackRock, Wells Fargo, and a few others. But let's start with BlackRock. $11.5 trillion. This is kind of the behemoth that just doesn't seem to get any smaller.
Yeah, that $11.5 trillion was up 26% year over year. And you guys are talking about the all-time highs in the stock market. So a lot of this asset growth is just coming from the fact that the market has been going up, but it's also coming from a record quarter of client flows, both from ETFs, but also into cash, and they're also making inroads into private markets. In their alternatives division, they saw $5.5 billion of total net flows. 2 of the top 3 ETFs that have taken in money this year are BlackRock products. The S&P 500 product, and Romaine, get this.
What's that?
The Bitcoin product.
No.
Yes, that's the 3rd highest U.S. ETF inflows this year.
But it's not just BlackRock and ETFs, though, right? They're alternatives, for example. But I was really struck by BNY Mellon and just how many investable assets they have. That was a tremendous leap.
Right. When you look at their assets under custody, $50 trillion in all-time high. Their assets under management also beat expectations. And they said that helped that a 5% increase in fee revenue. So they generate fees on any assets that they oversee. And so that in turn helped them top their profit estimates for the quarter as well.
Is there some sense here that this is going to continue? Emily, do we have any sense that this is just about the latest sort of leg of the bull market, or is there something structural that keeps this going?
Well, I mean, when you look at a company like BlackRock, they have managed to innovate this year. They're not kind of stopping. They're making those inroads into private markets. And then also one of their most successful products is a newer asset class, like a Bitcoin ETF. So at least from these
you keep talking
earnings,
about this Bitcoin ETF.
She's excited about it.
You have a Lambo parked out front or something that we need to know about?
It's done really well.
Didn't you see it? But it's not just, say, with investor assets. You also take a look at, say, Wells Fargo deposits and how they've grown as well. There's a lot of money in the system, full stop.
Right, exactly. But it was interesting to see their net interest income because that was a little bit of a disappointment. It was down 11% from a year earlier, which missed estimates, a sign that the bank is not benefiting from persistently higher rates. However, their investment banking revenue, which is kind of a totally different part of the market than just like assets growing, helped kind of offset that lower net interest income.
All right, Emily Graffeo here at Bloomberg News, helping to break down some of the earnings that we got this morning. She was just talking about Wells Fargo, and it certainly pleased investors. A 6% pop in the stock on the day. And as we count you down to the close, the CFO of Wells Fargo joins us now on Bloomberg. Mike Santomassimo, great to see you once again here. A relatively upbeat quarter, at least based on the reaction that we've seen out of investors and also by some of the comments that you and Charlie Scharf made on that conference call about the resiliency of the consumer. Can you expand on that a little bit more, Mike? What exactly are you seeing?
Yeah, well, first, thanks for having me again. And as you saw in the results of the quarter, the consumer has been quite resilient actually now for the last number of quarters. And I think you can see that in the activity levels. You can see that in the credit performance in the quarter. And you can see that in the underlying deposit franchise as well, as you were just mentioning. And so when you look just more broadly at the results, it's not just the consumer side, it's the commercial side as well. We saw good growth across most of the businesses in the fee side. We saw an expected decline in net interest income, but we feel like we're likely at the trough of the NII trend at this point. So there's a lot of good things underneath that underpin what you saw in the quarter.
Is there a sense, when you talk about the trough potentially that we are, is that largely a function of the move that we've seen in Fed rates, or is there something more to that?
Well, I think the reduction in rates does help, right? Because we've been able to adjust client pricing as a result of that. But you're also still seeing, rates are still quite high on a relative basis from the last few years, and so you are still seeing repricing happen on the asset side. But in the near term, what really drive where we end up over the next couple of quarters is the deposit side. And we've seen some good trends there now over the last couple of quarters, where you've seen this cash sorting or the different mix changes really moderate. It was the slowest quarter where, so far since over the last couple of years, for that in the portfolio. And we've been able to adjust pricing just as we thought we would as the rates came down. So that'll be the factor that really drives near-term performance.
So, Mike, it's good to chat with you. To that point, then, does that mean that the move into higher yielding, say, CDs or money market funds, et cetera, that's definitely done as rates cuts come down?
Well, I wouldn't say it's necessarily done, but I think we saw the lowest pace of migration since rates started increasing, Alex. And so I think that's a good trend. And I think eventually what you see generally, or expect to see generally, is that what's left in checking accounts ends up being operating cash for a lot of people. So a lot of that shifting into other alternatives has happened already.
Yeah, my high yield savings account already coming down there. All right, let's get to the loan part of your portfolio. When do you think you see a really big uptick in loan growth? What's going to be that catalyst?
Yeah, it's really hard to say exactly, right? And I think when you look at what we're hearing from clients and what you're seeing, rates coming down, helpful, right? Because borrowing costs come down. I think there's still some uncertainty related to the election that's coming up. And then I think people want to see this base case kind of soft landing economic scenario play out a little bit longer. And then I think a combination of those things will start to build confidence. And then I think you may start to see people either build inventories or make additional capital expenditures that they've been holding off on now for a little bit. But I don't think it's just one thing. I think you really need to see a confluence of these things come together, and so it could take a little bit of time for that to really materialize in borrowing.
With regards to that client activity, Mike, and the election, and the idea that once we get past that, maybe we see more activity, is that irrespective of who wins, or are they trying to hedge their bets?
Well, I think what people don't like is uncertainty, Romain, and so I think once there's some certainty of the path, and you feel like that economic outlook is going to play out the way they think, I think those things are going to what really matter, and then assuming rates continue to come down and reduce borrowing costs. So I really do think it's going to be a combination of all those things, but it's the uncertainty part that I think causes people to hold off.
I do want to ask you about some of the regulatory issues that continue to hang over Wells Fargo. Last month, Bloomberg did report that you had actually entered a new phase here to get out from under that Fed's asset cap. I am curious as to the progress that you've made in moving in that direction and whether you are anticipating that cap to be removed soon.
Yeah, I mean, as always, my answer might be a little unfulfilling, Romain, but I think we continue to very much focus on getting the work done that we have there, and ultimately it's going to be up to the Fed to decide when they're ready to do that. But we continue to feel like we're making really good progress. We're confident we're going to get through it, but ultimately it's going to be up to the Fed to decide the ultimate outcome there.
It definitely has to be Mike's favorite question, I think, when it comes to our earnings interviews. But what kind of spend profile do you think you're going to have once that asset cap is removed? Like, are we going to be like, all right, let's invest a bunch of money, or how's the plan sorting itself out?
No, it doesn't change the strategy that we've been executing on now for the last number of years. Like, we are already making the investments we need to make into the businesses to grow them over a long period of time, and we're paying for that through the efficiency program that we've executed now for the last 4 or 5 years. And I think we still very much feel, and I think Charlie talked about it on the call this morning, we very much feel like there's a lot more opportunity for us to drive more efficiency, and that'll allow us to continue to make the investments we need to make in each of the businesses. And we're going to keep doing what we've been doing now for the last 4 or 5 years.
We talked about the election in terms of the demand profile. What about your client activity in trading, for example? Like, how are your clients positioned? How are they thinking about the next few weeks?
Well, I think most people are probably hedging their bets a little bit, right, and making sure they're not taking too much risk going into what can be an uncertain environment. But volatility, as you know, can sometimes create opportunity for folks, and I think that certainly creates opportunity in a trading business like ours and others. And so we'll see how it plays out. But I think going in, we're going into this next month or so pretty cautiously as we sort of think about the risk we have in the trading side.
We haven't had a chance to really ask you about the state of the commercial real estate market, at least as it relates here to the business that Wells Fargo does. You clearly have some insights into that, Mike, and I am curious as to whether you've seen anything resembling a trough in what has been ailing that space, particularly in the office space.
Yeah, well, I think broadly commercial real estate's doing quite well. It's really an office story, where you see the most stress, and so I think in the other asset classes, you continue to see a lot of activity. You can see the CMBS market, securitization market, pretty active in other asset classes like multifamily. So really, that stress is in the office space. And it's really going to take some time to play out. We're not quite done working through those issues. And it's hard to call whether it's at a trough or a bottom, in that market at this point. And it's still the same trends, though, that we're seeing. Newer buildings in the right places are doing just fine. Older buildings are not doing fine. It's pretty consistent across the U.S., and it's going to take a while to play out. It's not going to be done in the next quarter or two. And for us, we've got a high allowance for coverage, coverage ratio in the credit book there in those institutional office properties. So we're really prepared for it, and it's for the most part, I'd say, kind of within the expectations that we had for it. But it's still not quite turning yet in terms of getting better for the properties that are most stressed.
Hey, Mike, we really appreciate it. It was fun to get your time today. Thank you so much. We'll get you in the next quarter. Mike Santomassimo, CFO over at Wells Fargo. That stock up, still right around the highs of the session, up by 6.4%. Let's get an investor take now at David Bahnsen, Chief Investment Officer at the Bahnsen Group. He's owned JP Morgan for about 15.5 years, and he joins us now. And it was a great quarter for JP Morgan as well. That stock is up solidly, David, about 5%. When would you sell?
Well, we would sell when they stop growing the dividend so robustly, which is their signal to us investors that they continue to have confidence in their business. So that's why we're dividend growth investors, Alex, because the dividend is the signal. JP Morgan's dividend coming out of the financial crisis was 20 cents a year. It is now $5 a year. Oh, yeah. The dividend is up 25x since the financial crisis.
So is that really like a quality then dividend play versus like a cyclical economy play for you?
Oh, very much so. I mean, we've owned it for 15 years. We're up about 7 times on our money, not counting the dividend. And JP Morgan is far and away the best bank in the world. Keep in mind, Wells Fargo's up a lot today, and they're up 100% since the financial crisis. JP Morgan's up 700%. That's the difference between the best bank and the second best bank. I mean, it's really just light and night and day in terms of their competitors.
I'm just curious, David, when we talk about the health of these banks, and more importantly, some of the commentary that we heard today about their view of the health of the economy and the health of the consumer, are you in that camp, this idea here that there is that resiliency and that there is that proverbial soft landing that's going to actually help out this market?
Well, I'm in the camp that wants to stay very humble about it because I recognize that there's data on both sides of this, and it's compelling data. And so to have an investment thesis that requires you to guess exactly what will happen with the economy and when has been a very bad idea for some time. There's a compelling argument. It's not just about the consumer being resilient. The consumer cannot carry the economy because the consumer cannot consume things that aren't being produced. There has to be production. So CapEx is going to have to continue to materialize and productivity will have to increase. So we're supply-siders to the core, production first. But yes, the fruit you see from that has been healthy.
Is there any concern about the election and, more importantly, the result, meaning the type of administration we get and the potential impact of policy coming out of it?
Yes, and I appreciate the question because I think it cuts both ways. There's things that could happen to impact markets or certain aspects of the economy from both candidates. I wrote a piece at my own dividendcafe.com summarizing we sort of like gridlock. If you do end up with a Harris administration but a Republican Senate, there's really nothing I worry about. They're not going to tax unrealized capital gains or other crazy ideas like that. With the Trump administration, much of the concern is more around some of the cultural and social dynamics. I mean, I think in both cases, we have a divided society, and there's a lot of social ills that are not going to be cured in this election. They're very likely going to be exacerbated. But all things being equal, we prefer deregulation and lower tax rates. But there's other things that matter right now in the economy, and I think politics is not even fourth on the list.
Not even fourth, even though we might get some tariffs happening? Really, not even fourth, David?
Well, and here's the thing about the tariffs. I happen to know and be very close with many folks that were inside the administration. I think President Trump was obsessed with the Dow, obsessed with the S&P. And so what is the worst case outcome there? He's told us he wants to use tariffs as a negotiating tactic. I don't know how they're a negotiating tactic when you tell the other side that you're using them to negotiate, but let's say they implement 200% tariffs on John Deere, which I think is up monstrously since he threatened to do that. And then the market drops a lot. I think he then capitulates. Like, there's no sense in which I believe there will be standing, ongoing tariffs that are able to take away, even though I'm against the tariff policy.
All right, Dave, before we let you go, I do want to go back to banks for a second and end there, because you just added Morgan Stanley on that, which in some ways makes sense when you saw the solid equity trading from JP Morgan. Why did you decide that was a good bet right now?
Well, we added Morgan Stanley about 2 weeks ago, and the equity trading is the last thing we would care about with Morgan Stanley, and that's by design from Morgan Stanley. You may recall, I was a managing director there for many years. I know the business very well. Ted Pick, their new CEO, might be the only person in America that loves dividends more than I do. They're at a 3.8, 3.9% yield, one of the highest yielders in all of the financial sector, and they have the recurring free cash flow. Their business is really annuitized. Wealth management, asset management fees, fixed income and equity trading, and even investment banking are a very low percentage of their cash flows. So they're not as lumpy. They have room to grow the dividend more, Alex.
All right, got to leave it there. David Bahnsen, Chief Investment Officer over at the Bahnsen Group. Stick with us, deeper dive into some of these bank earnings when we come back after the break. This is Bloomberg. Let's get right to our top calls. Big movers on the back of analyst recommendations, and we start with Ferrari, an upgrade to overweight at JP Morgan, which says the luxury car company has better visibility to its future than the murkier outlooks of its peers, and that's despite the slowdown in China. JP Morgan also boosting its price target all the way up to a street high, $525. The share's up about 3%. Next up, Affirm, an upgrade to overweight over at Wells Fargo, with the analyst saying that he used to find the buy now, pay later firm's valuation hard to justify, but now he says Affirm's pricing model sets the company up for years of 20% plus growth. Those shares having a great day, up 13%. And finally, TD Bank not having a good day. Cut to sector perform at RBC. This comes after the lender pleaded guilty in a U.S. money laundering case that will cost it $3.1 billion in fines and other penalties, a move the analyst calls the worst case scenario. Those shares, which of course slid earlier this week, down another 3% here on the day, and those are some of our top calls. We do want to say with financials, and particularly with U.S. banks, fresh off the earnings we got this morning out of JP Morgan and Wells Fargo. Joining us right now to give us his take is Macrae Sykes, portfolio manager over at Gabelli Funds. Were you impressed by what you heard this morning?
Yeah, from both those companies, both on the consumer side, the credit side. Obviously, Wells Fargo, the outperformer today, indicating kind of a path to some relief from this asset cap at some point. It's in the hands of the government, but I think that's a nice catalyst that we've all been waiting for the first 7 years. So that's great.
Given some of the commentary we heard on the conference call, both from the CFO at both companies, JP Morgan and Wells Fargo, they seem pretty optimistic about the health of the consumer. When we hear from Bank of America next week, and Goldman and Morgan Stanley, and then of course the regional banks, do you think we're also going to hear a similar upbeat tone?
I do in general. I think, it depends on sort of the segments that they interact with. So we know the higher end and the middle class is doing pretty well, employment, travel, all of this. But there clearly are some struggles with the legacy inflation issues at the lower end, and we've seen that in some of the consumer numbers. But overall, I think, the feedback we got is a pretty healthy, stable customer. And then, that also includes credit in terms of card fees and payments and so on. So that's a...
When we were talking to the CFO of Wells Fargo, we were trying to kind of understand where loan growth is going to really pick up and if there's a catalyst. And it was hard for him to answer that question. I mean, it does seem like there's some stabilization, but what's going to propel that loan growth is still a question mark. What do you see which banks benefits the most? Well,
they indicated with the asset cap, removal, one place they might look to, allocate capital be wholesale funding. So, typically those are the corporates. So I think that there definitely seems to be a lot of uncertainty, not uncertainty, but just a patience ahead of the elections. And so we'll obviously get some certainty after that. And then, we'll be more into the rate cuts at the back end of the year too. So a little lower rates, I think, will be helpful. I don't think there's expectations for a return to, we saw for the 15-year period of very low rates. So I think we're kind of in a normalization in terms of expectations around what the cost of capital will be in the next half year, and I think people will start to plan and look to grow their businesses, inventories, et cetera.
I have about 45 seconds left. Top bank for you right now. Top pick.
Oh, definitely Wells Fargo. I mean, even with the pop today, I think people are going to relook at this. It's been in the penalty box for so long, so worn down by kind of this regulatory news that, for them to get back to growth and the opportunity to deploy capital and also buy back shares post the Basel, I think this is a great opportunity.
All right, Macrae, thanks a lot. Really appreciate it. Thank you so much, Macrae Sykes over at Gabelli Funds joining us on that. So my question is, if the deposit beta sort of comes down, right?
Yeah.
Are they going to keep lowering my high-yield money market funds?
I think so. I track this every day. You track the number of record highs. I track the number of times my savings rate keeps going down.
And?
They're pretty quick.
Awesome sauce. All right, much more coming up. We're going to talk about the economic environment and hedge fund positioning. This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. 45 record highs for the S&P. Here we go.
45 record highs, and this one seems a little bit more meaningful than the last. I don't know. It just seems like the price action is just a little bit more definitive than some of the past record highs that we've seen, at least over the last maybe 3 or 4 months.
Well, because it's also coming with banks leading, right? Like that's a real part of the economy.
Exactly.
It's not being led by, say, Nvidia, which we love that too. But this is like the real cyclical part of the economy.
Absolutely.
The other part of the interesting data point that we got out today, you can really see the S&P taking another leg higher once we got that UMich number. Yes, consumer sentiment unexpectedly fell for the first time in 3 months, but there was a real push and pull between what we saw in the jobs market as well as inflation. Well, joining us now is Joanne Shu. She leads the data there for University of Michigan. She joins us now. Joanne, talk to us about how people and your respondents are looking at a still solid labor market and yet inflation that remains sticky.
So consumers have absolutely noticed that inflation has slowed down over the past couple of years, and their sentiment levels have improved quite a bit since then. At the same time, they remain very, very frustrated by high prices. And so that bears out in the data that we're seeing right now.
How much of this also is a function of us being so close to an election? Obviously, survey data can really waver depending on when that survey is taken. And there's been a lot of anecdotes out there saying that people tend to, I guess, have a little bit more jitters once you get close to a big election cycle like the one we're in right now.
The good thing is that we've been collecting data every day, and we've been in the field every presidential election year since the 70s. And what we can say right now is that consumers are folding in their expectations for who they think will win the presidential election when they're forming their economic expectations. Now, of course, who they think is going to win the election might change over time. And what we are hearing from consumers is that, for many of them, their responses assume one candidate is going to win, not necessarily the candidate they favor, but they're assuming it anyway. And if the other candidate wins, all their expectations might change. And so at this point, consumers are really reserving judgment about the long-term trajectory of the economy because they know a lot is up in the air right now.
Well, we were just talking to the CFO of Wells Fargo, and on the business side, he was saying after the election we get clarity, you could see some pent-up demand, say in loan growth or companies willing to spend. Do you get the idea that on the consumer front it's the same? Let's just get past mid-November, and then we're going to spend some stuff.
I think that consumers are reserving judgment, and they will be more willing to spend when there's a little bit more clarity about what's going to happen in the year ahead in the next 5 years. That being said, the reason why consumer spending has been relatively strong for the past couple of years, in spite of high prices, is that labor markets have been very, very strong, and incomes have been strong as well. And what we actually saw this month is that for consumers, their labor market expectations strengthened in October relative to September. They're expecting more strength in their incomes. And they're not really expecting unemployment rates to go up, largely because they do expect the Fed to step in if the labor markets start to weaken again. And so that definitely bodes well for the consumer's willingness to spend, along with this upward trajectory and sentiment that we've been seeing in the last few months.
All right, great stuff. Joanne Sue, of course, she is the director of consumer surveys over at the University of Michigan. Fresh off of that latest report that did show deterioration in that headline number as outlook amongst consumers, both in terms of what's happening now and what happens in the future. That's actually going down. Now, some of that, of course, is affected by the election, and that's also having some ripple effects on Wall Street, where hedge funds really are taking a wait-and-see approach right now when it comes to investing, with right now just less than a month left until Election Day. Our next guest says he's waiting until there's more clarity before making significant politically connected investment bets. Jonathan Caplis is the CEO of hedge fund research firm Pivotal Path, and he joins us right now. And talk a little bit about the research here. I was looking at some of the prime brokerage data that we get out of companies like Goldman and Bank of America, and it really does seem to show that a lot of folks are on the sideline, though still holding on to some equity positions. What did you find, John?
Yeah, sure. Well, thanks, Romaine, for having me. Hedge funds typically don't make big wagers on the outcome of the election in advance. And especially of elections that have been extremely close over the last 40 years. 3 out of the 4 last election cycles, hedge funds have ramped down their positioning actually in late spring, in May and June. And that's where they've typically bottomed before more information comes in and starting to increase their exposure. That's exactly what happened this year. It bottomed in May and June. And then we've seen hedge funds actually increase their exposure over the last few months. But what's interesting is the uncertainty around the election is still there. There's no more information, or at least no large bets one way or the other. That being said, there are so many other factors that are driving opportunities, and so they don't want to miss out on those.
I am curious, though, too, like as you're doing these surveys and you're talking to these folks, I know we're focused on the election, but we'd be remiss in not pointing out there's a lot of other things going on in the world right now that would give investors pause, from some of the military conflicts in the Middle East and concerns about the world's second largest economy in China. Did those things at all factor into the sentiment that you found with regards to hedge funds and their positioning?
Yeah, I mean, hedge funds definitely, I think, first and foremost are looking at central bank policy, Fed policy, number one, Chinese policy, and that stimulus is definitely affecting the way that they trade. But I think, the broader trends in AI, especially, go beyond politics. And so there are some trends that they have been playing throughout the year. And I think it's important to note, partially about where hedge funds stand year to date as the election nears. So technology, medium, and telecom index that we track with over $50 billion in technology assets, they've been trimming their exposure, partly because they're up about 15% year to date, which puts them as the best performing index among the 40 indices that we cover. So as they look around for the rest of the opportunity set, they're starting to take profits, basically because they don't know what's going to happen again around the election. And they do know that after the election, they'll have more clarity, are hoping for some maybe outsized moves in the markets that they can take advantage of. But for now, they're starting to pare down their positions, at least on those that have been so profitable.
John, on that point, are hedge funds actively playing election volatility, or do you think it's a kind of wait and then settle out?
Yeah, I don't think that they're actively playing it. At least, almost every hedge fund that we speak to, they're calling it a coin flip. I think that's, the basic sentiment. That being said, you can definitely see in the markets that historically, and when I say historically, over the last few months, even during the first couple of days after the Biden debate with Trump, you saw huge moves in energy, clean energy versus traditional energy. So clearly, as more information comes in, they will make trades. But at this point, when there's so much uncertainty, they really are sitting on the sidelines, and not sitting on the sidelines in full, but only investing in opportunities that they see as basically agnostic to the winners.
Yeah, longer term. John, you mentioned what was happening in China as well. So I feel like here in the U.S. in the last couple of months, we went from, a growth scare to a soft landing. And now when you add in potential China stimulus, are we looking at sort of a re-acceleration, a reinflation of the economy? And I'm wondering if you were to put hedge funds in a bucket of that, on that spectrum, where they would sit.
Sure. I think hedge funds have definitely been very weary of China for some years. They definitely started to invest in China over the last couple of years, but I'd say in the last 18 months, they've definitely pared that back, partially because of their own internal policies and regulations and what they've done in Hong Kong. So hedge funds aren't really playing China nearly as much as they have in the past. They're staying away from that. Where they are playing are regions that are benefiting from that. So Japan especially, but certainly Pan-Asia outside of China, they're definitely seeing this opportunity from Chinese stimulus going to help in those areas. And that's also going to help with a lot of their big tech bets.
All right. Very insightful stuff here, John. We got to get you back here, particularly once we get to the other side of this election outcome. Jonathan Caplis is the CEO of hedge fund research firm Pivotal Path. When we come back here, we're going to focus on, well, two of the biggest movers of the day. Tesla, your biggest decliner in the S&P 500. Uber, your biggest gainer, and it's all because of that big event that Tesla had last night, a Cybercab and a robo-van.
Tron.
I know, Alex is a fan. We're going to see if investors maybe are willing to jump on it as well. That's our Stock of the Hour, and it's coming up next. This is Bloomberg. All right, time now for our stock of the hour, and it is Tesla. The share is down about 8% here as we move closer to the closing bells. This just a few hours after Elon Musk revealed that highly anticipated robo-taxi, along with the van concept and an updated version of its humanoid robot. Musk's presentation lacked technical details and glossed over a lot of topics like regulation, safety, and other things, leaving investors questioning just how realistic these prototypes are. Here to discuss is Bloomberg's Abigail Doolittle here. And let's talk about the reaction that we're seeing, not just in Tesla shares, but the pop that we saw in the ride-sharing companies, Uber and Lyft. And it was kind of interesting to juxtapose it because Dara Khosrowshahi earlier this year basically said that he doesn't think self-driving, autonomous driving is really going to be viable, at least in as far as the taxi space, anytime soon. Meanwhile, Musk is saying, look, we can do this in, what, a year and a half? Is that effectively what he said last night?
So I think that he said we may do it in about a year and a half. I think he said that we're going to start producing it in 2026. They might really get onto the road in 2027. But we had this conversation before, at least a piece of it, that he's building this huge AI ecosystem that's really, really far in the future. So relative to the stock today, and not just this stock, I'm so glad you brought up Uber and Lyft and even Rivian, that they're eating these declines. The stock action today really has to be separated from this robo-taxi. So the stock up 70% from the April lows. Some of that was just the Tesla recovery in terms of the actual story. Next year, we're looking at 37% on the bottom line, if they can achieve it, 17% on the top line. And this stock has been down 3 days. So a little bit of a sell the news event. That's today. In the future, again, it's this massive ecosystem that he's planning on building. I think it's almost beyond comprehension in some way. It's not linear. I mean, this vehicle...
It's beyond comprehension?
I think so. Or you really have to stretch your imagination to get where he's going. This is going to be, I did not see the movie iRobot, but an analyst was telling me that the We Robot clearly taken off of that. And you guys are talking about this movie Tron, which I also have not seen clearly. I have to catch up on my science fiction sometime soon. But these are amazing.
Have you seen Total Recall?
I have not, actually.
Oh my goodness.
No. I'm more like the spy thriller. Although I have to get more into the science fiction. But in any case, these vehicles, they're beautiful. I mean, that Cyber Coupe, I think he should really call it the Cyber Coupe Cab. I mean, that would be great. It's very catchy. And then that bus is amazing, too. But again, this is very futuristic. In terms of when these vehicles actually hit the numbers, our analyst here, our Bloomberg intelligence analyst, who's fabulous on all of this, Steve Mann, he said in 2032, $1.5 billion in revenues, much later in the 2030s for profits. By 2028, maybe $50 million. So it's really
for this thing?
Yeah. So
where is this driving, Abigail? There's no state in the country right now.
Exactly. The regulation is the biggest deal, and we have to remember it's a prototype. It's going to be really interesting to see whether
was it moving on its own power. Or was it like, Fred Flintstone in there, like with his feet on the ground, like he did with the human
I think there was a lot of Hollywood going on there, but you have to remember that AI and also that it goes by cameras as opposed to lasers.
You love this thing.
I do.
I know. It's amazing. It's so beautiful.
Straight up Tron. All right. I'm just going to keep saying that throughout the day. All right, Abigail, thanks a lot. Really appreciate it. Bloomberg's Abigail Doolittle. We're about 15 minutes away from the closing bell. 45 record highs. This is Bloomberg.
This is the countdown to the close. Just about 10 minutes until we get to those bells, Alex. And looks like we're going to end the week on a high note here. Remember, we had that big rally on Tuesday, but there was a little bit of softness in between. But look at this. Back here on a Friday, and a massive rally in our hands.
Yep, 45 record highs on the S&P at a record. You also have mid-caps at a record as well. And obviously, financials helping to lead the way. Uber, the best performing stock in the S&P, but also it's Fastenal. And that's what I like about this. It's an industrial company, and it also did quite well. It said they saw sequential improvement in daily sales for industrial and construction supplies, right? That's also a real economy story.
And this is what I really want to hear out of this earnings season, whether we are going to get more commentary about the economy that is upbeat. We heard that today from at least the CFO at JP Morgan. Jamie Dimon himself seemed to be a little bit more curmudgeonly. And then, of course, we heard that from both the CEO and CFO over at Wells Fargo. So whether we hear that from other companies as well, beyond just the banks and Fastenal, will be interesting to see.
Yep, and also the idea of what happens after we get past the election. Are there clients and companies like waiting on the sidelines to invest? And does that actually bring forward some investment cycle? That's a good point here. And I think when you take a read of sentiment right now, whether it's consumer sentiment, investor sentiment, or anything in between, there are a lot
lot of bright spots out there. Let's get some insights out of our next guest. Dana D'Auria joining us right now. She's the Co-CIO at Envestnet, helping us count down to these closing bells. And Dana, I do want to start there with sentiment overall, particularly when it comes to investors. And there does seem to be a little bit of a shift. This idea that whatever you think interest rates are going to go, the idea is that you have an economy that has proven to escape recession. And for a lot of folks, they're looking at an economy that they think actually has the potential to reaccelerate from where it is right now.
I think that's accurate. And, it's pretty interesting, too, because you have a lot of research that comes out about where we're headed now with markets. And, some of that is, some of what you're hearing is based on this understanding that, the Fed is cutting and what typically happens when the Fed cuts. But we're in an interesting dynamic, to your point, where the Fed is cutting, but we're not seeing weakness here, right? Yeah, maybe some consumer sentiment concerns around, how high prices have become. Obviously, inflation flirting now with, core inflation being a little bit of a sticking point. But at the end of the day, most of the signs are positive, more positive than you might expect in a Fed cutting cycle. And so we're an interesting dynamic. If we can get through the volatility of the election, I do think there's a fair amount of upside.
Give us a sense here of where you think that upside will be, specifically within the equity space, because we've seen a big part of the complexion of the rally that we've been in for the last few months is the idea that this has not been necessarily a rising tides lifts all boat type of rally.
Yeah, no, you're so right. I mean, look, if you look at the last quarter that just ended in September, we did see more breadth come back into the markets, which was obviously very nice to see. It wasn't, this dominating tech story or, communications story. But taken together year to date and, even where we're, seem to be now, there's no getting around that. The large caps have completely, blown out and growth stocks have, outpaced value stocks. So it's tempting to say, look, if we, again, notwithstanding the election volatility that we've got coming, September and October tend to be very volatile ones. September certainly was, in spite of delivering a nice performance in the third quarter. September was volatile, especially the first couple of weeks. And then, October, I should expect volatility too. But yeah, I mean, taken together, valuations being where they are, you'd expect that if we continue to weather the storm, we are going to see more participation in areas like small cap companies.
Do you think we extend the economic cycle then?
Yeah, I think, look, there's no knowing for sure that we've sort of beat this, right? And we still have, indicators. Again, we had core inflation come in and, that looked a little hot. We know there's research certainly pointing out that inflation tends to come in waves. So now you're getting a little bit of a stagflation story starting to bubble up a little bit. Things like that do give you pause for saying, that the coast is clear and that, in fact, we've got this longer run bull market that we can enjoy. But again, the preponderance is in favor of this.
Does that imply then a continuation of the U.S. exceptionalism that we've seen in the past decade, whereas I feel like every start of the year we think it's going to be different?
Yeah. If you look historically and just look at something like the MSCI EAFE versus the S&P 500, they do tend to trade dominance, right? And when you go through 10-year periods of dominance, you really start to go for a narrative that says, no, this time the paradigm is different. There really isn't a reason to start investing overseas. But you look historically, something like the lost decade, for example, where U.S. stocks delivered nothing. You lost money in the standard market cap weight. But if you were in international stocks, you were fine. And then so you have this recency bias and you get to thinking like, yeah, no, the storyline favors the U.S. I tend to want to look longer term. I tend to want to say, hey, look, I don't want to not include a huge part of the global productive enterprise out there that's available to me as an investor. So I am a proponent, and I also think markets are efficient and they price, they price those respective potential future cash flows well. And so I am still an advocate, notwithstanding that, the globalization dividend is under attack. We are going to see less of that. We are going to see, as a result, probably higher base rates of inflation. But I still think as an investor, it makes sense to me to be invested overseas as well.
How do you balance out that portfolio, though? So, I mean, let's just say you do get the proper allocation. Maybe you're overweight in the U.S. here. Outside of equities, how are you balancing that out? Is it just straight fixed income, or do you layer that with a few other things as well?
So I will tell you, we're Envestnet's in the retail advisor space. We look a lot at, obviously, where the trends and flows are going. There's always this question around, I think, where you're going, the 60-40, right? It's equities, and then do I just have my fixed income for ballast? Very much we're seeing attention turn towards alternatives and, just the innovation that we're seeing in the space around the types of vehicles that are available to retail investors. So I don't have to go all the way to LPs, right? I have interval funds. I have tender offer funds where I can get a little bit of a taste of this illiquidity premium, maybe a little bit of the higher returns that can come from that. But I don't have to leave a closed-end vehicle. I still can be in a closed-end space. I think we're going to see more and more of that, and that's going to really diversify what used to be this 60-40 paradigm.
All right, great stuff, Dana. I'm going to have to leave it there. Have a wonderful weekend. Dana D'Auria, she's Co-CIO over at Envestnet, helping us count you down to the closing bells here on this Friday afternoon. Alex, just about 3 minutes to go here. And it gets to this idea as to what's really driving this. Is this really about that economic narrative? Is it more about, I don't know, interest rates themselves, or is it all just kind of all tied together?
And it is surprising headed into a weekend where we have uncertainty as to Israel's response to Iran and also China as well in terms of unleashing any supply in the market that will ignite any kind of stimulus, but we're still taking on the risk.
Yeah, still taking on the risk. Obviously, a big meeting in China on Saturday, or at least our Saturday here, and then we talk about this idea of an earnings season that will really start to pick up towards the middle of next week. Meanwhile, here on this Friday, a full breakdown of all your market coverage starting right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele taking you to the closing bell. A global simulcast. It starts right now. We're joined right now in the radio booth by Katie Greifeld and Matt Miller, filling in today for Carol Master and Tim Stenovic. And Scarlett Fu, as always, joining us here in the television studio as we welcome our audiences across all of our Bloomberg platforms, including, guys, that relationship that we have with YouTube. Katie Greifeld.
It is so great to see you, Romaine Bostick, especially as we are just moments away from the 45th record close on the S&P 500. Can you believe it? Here we are, of course, being buoyed higher by the big banks today.
Yeah, just powered higher, and we saw that kind of a slow start this morning at the open. I don't know if you're aware, Katie and I also anchor Bloomberg Open Interest, which takes you through the most important hour of the market, the open. And we saw the banks start to gain a little bit and then gain some momentum and really power higher until JP Morgan was up 5% and change. We saw Wells Fargo, even with maybe a little bit of disappointment in its earnings release, up more than 6%. The financials, the biggest gainer in terms of industry groups.
Yeah, if you look at the KBW Bank Index, 23 out of 24 names are higher. And what we saw from some of the banks may kind of set the tone for earnings season, which is analysts have been ratcheting down their estimates for third quarter results, while management looked a little bit more optimistic. So that creates a lower bar to beat. And we all know that that typically is what happens, but it gives us some momentum going into this earnings season.
What I was really into is Fastenal. Romaine, you and I were talking about that earlier. That did really well. That's industrial, real economy stock.
Yeah, absolutely. And look at the commentary we got out of the banks. That was real economy talk here, and that provides a little bit of a boost to sentiment here on this Friday afternoon, where we take a look at an S&P 500 off the highs of the day, but above that 5,800 level, 58.14 and change as we wait for these numbers to settle. That's going to be good enough for a 0.6% gain on the day. And yes, another record high. The NASDAQ composite also higher on the day by about 61 points or 0.3%. The Dow Jones Industrial Average, which is now Alex Steele's favorite index, or average, I should say, up about 1% here on the day. But take a look at the Russell here, because it really has gotten left behind in this broad-based rally that we've had going back over the last couple of years. But it is playing catch-up. An outperformance on the day, up about 2% here, as it now logs a weekly gain and came into today looking like it was going to have a weekly loss.
All right, meanwhile, you take a look under the hood. I know we're all about the big banks today, but big breadth in this market. In the S&P 500, 434 stocks closing in the green, just 68 stocks in the red. And Scarlett, according to the Bloomberg terminal, there was exactly one that was exactly unchanged.
Exactly one. Well, we'll see if that remains the case as the market settles. But in terms of how things are shaping up with sector performances, there are actually a lot more gainers than decliners. 9 out of the 11 groups are in the green. But the reason why it looks so lopsided is because tech, which is the biggest sector in the S&P 500, is basically finishing unchanged. Consumer discretionary down 0.4%, and that's mainly because of Tesla. Among your gainers, we've been talking about the financials, up almost 2%. Industrials gaining 1.8%. That gets back to Fastenal, which Alex was just talking about, and real estate investment trust gaining more than 1% as well.
All right, let's get to some gainers right now. I had plenty to pick from, so we'll start with Uber, of course. We were talking about what a bad day Tesla's been having, of course. Its robo-taxi event, the RoboCab, didn't exactly go over too well. Scant details. That's all good news for Uber, at least according to this market. Uber shares finishing the day almost 11% higher. And then Fastenal, really interesting one. Like Alex said, a real economy stock here. It's a distributor of industrial and construction supplies. It provided a third quarter reading that showed sequential improvement in daily sales. People clearly psyched. You can see Fastenal having a great day today. And then I had to finish with the financials here. I picked JP Morgan, because it's the big one. Having a great day. Of course, it beat on investment banking fees. Ooh. It beat on net interest income, et cetera. It had a great day. And exciting. You saw it throughout the whole sector.
It's not exciting as fasteners, though.
No, I agree with you.
I agree. Thank you.
We're all in alignment here.
Well, I mean, it depends how you look at it.
Go on.
It was just 1 month and 1 day ago that Daniel Pinto came out and said JP Morgan was going to miss on net interest income, and the stock tanked. It had its biggest drop in 4 years. Oh. And now that feels like it was a setup for today.
Wow. Well, they did also say that 2025 estimates are a little bit too high, and that JP Morgan is not going to make the full year 2025 numbers as they currently stand.
2025 is like 15 years from now. Who cares?
And you're certainly not seeing anyone thinking about that today.
No, it's a long way away. I'm looking at the losers in today's market. Obviously, Tesla was a huge one after the big disappointment that was yesterday. Elon Musk announcing their self-driving taxi at an event that was very flashy and at a movie studio, Warner Brothers, I believe, but was light on specifics. Didn't tell anybody about technical details, glossed over topics including regulation, because that's important. You can only actually make and sell 2,500 vehicles without a steering wheel, and that doesn't seem like enough to make money. He didn't say who's going to own and operate the fleet of cyber taxis, so it left, I think, more questions than answers. Stellantis was also a big loser today.
Wait, are you doing 2-car companies?
Yes.
He's doing
probably doing 3, right? I haven't looked that far ahead.
I mean, you could argue, I think Tesla investors would argue that that's a technology company and not just a metal bender.
No.
But Stellantis
They're a consumer discretionary company.
Isn't doing well bending metal either. They have slumping sales in North America. They delayed a new model introduction in Europe. They have quality issues, the threat of strikes. Globally, car sales is coming under pressure right now. And Carlos Tavares, there was talk about whether one of the big owners, Johnny Elkann, would get rid of him before he retires in 2026. That didn't happen, but Tavares threw the female CFO under the bus. She's only been there for less than a year, and now she's out. I also have AOS. Have you ever heard of AOS?
Yeah, is that the water pump company?
Yeah. Water heating and water treatment equipment. I hadn't heard of it, but it is a member of the S&P 500. One of that index's 503 stocks, down after lowering its annual forecast for net sales and adjusted earnings per share, citing continued softness in its China business. I'm here to say that if you pay attention tomorrow, this could be a big gainer on Monday, because the finance ministry is going to lay out how much it's going to give in stimulus. We're hoping for 2 trillion won, I think. That's the consensus. Also, TLN fell, and a bunch of other power companies, including Vistra, Alex, and Constellation. TLN is Talon Energy. This after regional grid operator PJM said it supports a delay to an electric capacity auction by 6 months. You probably know more about this than anybody else, but I just think it's interesting to watch these guys fall. A couple days ago, we thought they were dropping because of Google.
Yeah, I mean, so they've also had a really big run too, right? So if you're going to sort of right size a portfolio, or you're going to sell some of the winners, like some of these guys are the best performing stocks in the S&P so far this year. Okay, I'm going to the bond market here. here, you were looking at higher yields in the back end, lower yields in the front end. So it feels like everyone thinks the steepener is definitely happening, but how we get to the steepener, is it going to be a bear or a bull steepener? Is it because that front end comes down or the back end goes up? We've seen the latter over the last couple days, and kind of what that means for the market will be quite interesting going into next week.
All right, something to keep an eye on there, but it's a Friday afternoon. Let's talk about breakdancing. And just to bring the viewers into the TikTok here, I know that you guys wanted to talk about this. So breakdancing, we all learned a lot about it because of the Olympics and, of course, whatever that.
Except they didn't call it breakdancing.
Oh, yeah, it was just break. Yep. But anyway, we learned a lot about it thanks to Australia. Apparently, doctors are warning about a breakdance bulge that dancers can develop. It's on the top of their head. It's when they get on the top of their head.
It's called a head spin, Katie.
Yeah, I don't know. I don't watch breakdancing.
Of course you don't know. I don't know how any. Look, this story came out because of a 30-year-old who I think is Danish. He got breakdancing bulge. He got a big protrusion on the top of his head, and doctors thought, is it cancer? What's going on? They did like an MRI.
He was just breaking too hard.
He was breaking.
He was practicing too much.
How does a 30-year-old, like breakdancing is for guys like me and Romaine. It's for 50 or 60-year-olds.
Oh, no. First of all, they said he started like when he was like, a preteen, and he was like practicing like 5 hours a day. So I guess, look, if you're spinning on your head 5 hours a day, every day for like 15 years, I think something would happen to the top of your skull.
I'm going to try it,
right?
you know?
You're going to try it.
I'm not a scientist or a doctor, but I would think so.
But if you played one on TV, that's what you would think.
So does he go bald too, or he just gets the bulge, but it has hair on top?
It's a great question.
It's a growth of skin, so I think it's just a bulge. All right, quick question, you guys. I know it's been all over social media, but did any of you capture Northern Lights last night? Yesterday?
No, I'm so bummed.
Look at that. You know what, though? Sometimes the pictures come out better.
You're talking about actual Northern Lights.
Yes, indeed. That's
We're being very earnest here. We're talking about Northern Lights in the sky, the show. No?
Amazing.
No
so, okay, no, I didn't see it. It's supposed to happen tonight, but it's moving farther north. So you have to be in like northern New York. It's really not going to hit New York City. I cannot. This is like on my bucket list in a big, big way, and I'm so bummed.
Yeah, well, it looks beautiful, and at least we have the photos.
I feel like we've been getting more Northern Lights instances in the last couple of years than before.
Isn't it?
That's true.
Yeah, you can see them up by us. You can come over to my house tonight.
All right,
and,
that's far.
I'll do that anyway.
I have a Pilates class, but listen, we have to go, guys. That does it for our cross-platform coverage of the market close on Bloomberg Television, Radio, and YouTube. A reminder that Bloomberg Business Week, it's now on Bloomberg Originals. I feel like it's been there for a while, though. In any case, we'll be back on Monday. Have a great weekend, you guys.
And our coverage continues right here on Bloomberg Television. When we come back, a closer look at the world of entrepreneurship, including a conversation with Grammy-nominated rapper Jadakiss and his break into the coffee industry alongside his father and son. You don't want to miss that. Stick with us. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostick. Another wild day on Wall Street, but this time to the upside, closing out a fifth straight week of gains for the major indices. That includes the S&P, the Dow, as well as the Russell 2000, believe it or not. Only about a 1% gain on a weekly basis. These are the numbers you're looking at after a 2% gain here on the day. As you now start to see a bit of a broadening in the rally in this market, a rally that we should point out started 2 years ago tomorrow. So on the eve of that anniversary here, you're looking at an S&P 500 that has rallied 60% over that 2-year period, a Russell 2000 that has rallied about half of that, and a NASDAQ index that has rallied about 90%. And a big part of the question is what's going to lead this further? Is it going to be big tech, or is it going to be something like financials? The KBW Bank Index up 4% on the week.
Absolutely, and that's a big question here as we begin earnings season. Let's start, though, with the big movers of the day. And we're going to lead things off with Tesla, worst performer in the S&P 500 today and for this week, following its robo-taxi event, which unveiled a prototype for a self-driving vehicle service. The event was long on hype and very short on details. It plunged as much as 10%, but obviously closed off its lows. Uber got a big boost. It was the best gainer of the week in the S&P 500. A Jefferies analyst called Tesla's taxi concept toothless and said that the event was the best case outcome for Uber. So we're also seeing Lyft, Uber's smaller competitor, get a lift as well. Lift. Okay, and we're also taking a look at JP Morgan. Romain mentioned the KBW Bank Index, biggest advancer in the Dow Industrials after reporting its results. Net interest income is the metric to watch. Third quarter beat, and for the fourth quarter, it raised its outlook as well. Now, our top story this hour is the startup economy here in the U.S. During the pandemic, the number of new business applications absolutely skyrocketed. You could see it right here. And then it kind of came down a little bit, but then there was a second surge in 2021. Now, while the pace has certainly eased, what you can see is that the monthly rate has stayed above the trend that we saw pre-COVID. And this is important because a jump in startups tends to be a positive sign for job creation, for innovation, and of course for productivity growth in the economy. So we're going to be speaking with entrepreneurs and leaders shaping tomorrow's economy, people who see white spaces in different segments of the world, from baby food to coffee to sports media, as well as data analytics. Romain?
Well, let's start there on the data analytics side, because almost 75% of CPAs are at or near retirement age. It's a lopsided representation that's made a lot worse by a massive drop in new entrants into the accounting industry, and that has deepened the drought of qualified financial professionals. But our next guest says that drought will worsen, but she has a solution, a data-driven solution that she says can assume some of the entry-level and mid-level tasks left open by the dwindling number of new accountants. It's called Heron-AI, and it was the recipient last night of a $1 million investment from 43 North. It's a Buffalo, New York-based startup accelerator program that for the past 10 years has held Shark Tank-style competitions to help fund the next generation of entrepreneurs. And I'm pleased to say that the woman you see there on stage, she joins us now. She's the co-founder and CEO of Heron-AI, Daphne, winner of one of those 1 million prizes. First of all, congratulations on winning the contest last night, Daphne. There's a lot of discussion right now about how you take some of these novel ideas that we heard pitched on that stage last night and make them reality. And I want to start off with where you see the accounting profession and why something like your platform can actually resolve some of the hiring issues that it's been in.
Yeah, it's a super great question. Thank you so much for having me today. So as you mentioned, in the next decade, there's going to be this huge disruption where 75% of accountants and CPAs plan to retire. And so really what we're looking at is this massive disruption, which really needs automation to kind of take its place so that as the workforce kind of shrinks, that there will still be something in place to be able to create these reports and analytics that are kind of the base of all accounting.
Who exactly are you targeting in terms of what size firms are you really going after here with this project?
Yeah, so right now we're starting with the SMB market. So we're really looking more in the mid-market range. And this is because a lot of these companies are in their growth range and they're really looking for these automated solutions, even though they know that they're going to have fewer staff in the coming years. And so we're really trying to make sure that as we move into this disruption, that we have created a solution that allows them to continue to grow their business, but also scale it in the next coming years.
And I know you're from Massachusetts. You did a lot of your graduate work at Harvard and MIT, but you participated in this 43 North Accelerator program, which is based in Buffalo, New York. How did that come to you? How did you get involved in that way?
Yeah, so I actually did my PhD at the University of Rochester, where I actually started my very first business. And so my first business, what we did was we worked with over 100 different businesses to help them grow and scale their own businesses through the use of data analytics so that they could make their own decisions based in data to know what they needed to do to scale their business. From there, I actually moved on to a postdoc at Harvard and then also at MIT, where I met my co-founder, Julian, who is the CTO of our company. And we both had the same vision, which was that we really wanted to empower people to drive the success of their business through analytics.
And as one of the winners of the 43 North program, you'll be relocating to Buffalo as well. I mentioned how startups and new businesses are really an engine for job growth. How are you thinking about finding talent in the Buffalo area versus where you were before in Massachusetts?
Yeah, absolutely. So we're really excited about that. We've already started looking out for new software engineers. We're also going to be looking for sales and business managers as well. And also, if anybody who's watching this in the Buffalo area is interested, we definitely would love for you guys to get on our website and check us out. But we're starting to work through some of the mentorship and some of the connections that 43 North has, and then also some of the colleges in the area as well.
When we talk about the potential for this business to scale up, Daphne, give us a sense here as to how you envision that happening. And I know that, you're only, a few hours, less than 24 hours removed from that big stage there. So I know you haven't had a lot of time to think about it, but I'm sure prior to this, coming into that competition, you had some sense of maybe how you would be able to get there.
Yeah, so we actually grew a lot faster than we expected. We more or less started building in January of this year. We were featured on Forbes a few months ago, and we've grown from 250 people on our waitlist to over 1,600 companies on our waitlist. So we intend to convert about 10% of that in the next year while we are at 43 North, and we're specifically focusing on accounting firms in the Western New York region. So we're really looking towards some of the mentorship that we're going to get with 43 North. And as you guys see, this is our website. So please come on to our website. And anybody who's interested in doing a pilot in the next few months with us, our newest version is about to come out.
All right. Well, congratulations, Daphne. It was a fantastic night last night, and I had a chance to be up there and see all of you pitching everything. And as soon as you went into your pitch and the way you handled the questions from that sort of Shark Tank style panel really impressed a lot of folks, and we wish you the best of luck.
Thank you so much.
It's all about investing with the entrepreneur and not always the idea, right? I mean, the idea is part of it, but the entrepreneur themselves is what the draw.
Yeah, and I spoke with a lot of folks out there, the judges and other investors out there, and they talked a lot about this. They're really looking at the talent.
Yep.
I mean, the idea matters, but it's the talent and the people running it. And obviously, if you just take a look at her resume, there's no doubt as to why the judges honed in on her.
All right, well, the talent matters. Coming up, we talk with another entrepreneur bringing their A game. Chad Mumm is the executive producer of Netflix's Full Swing, and he's teeing off on a new golf media venture. This is The Close on Bloomberg. Chad Mumm is chipping away at his next venture. The executive producer of Netflix's Full Swing is now teeing off his new golf media startup, which has garnered backing from the PGA Tour itself. Chad Mumm joins us now. He is founder and president of Pro Shop Holdings. So, Chad, welcome to Bloomberg. PGA Tour has invested in your Pro Shop startup, but explain to us how this relationship will actually work. How will it show up in the content that you produce and the events that you host?
So the golf audience, ever since COVID, really over the last decade, has just gotten a lot younger and a lot more male-female split, a lot more diverse. And I think golf in general has exploded in popularity across Instagram and social media as more people are taking up the game. And so the relationship with the PGA Tour began with our partnership to create Full Swing on Netflix, the doc series. And after 2 seasons of that show, I ended up in a conversation with the PGA Tour about how do we take this kind of deep access storytelling that maybe pushes outside of what people think of when they think about pro golf, inside the ropes, broadcast TV, and do some more interesting storytelling. And so our relationship with the PGA Tour allows us to use highlights, shoot and create content on site, primarily focused on sort of digital storytelling to reach this next generation of golfer.
Now, you mentioned Full Swing. Clearly, the PGA was on board with that, but they let their golfers star in the series, but they didn't really interfere in the stories that you did tell. Otherwise, we wouldn't have seen the Live Golf versus PGA battle kind of play out the way that it did. Are they going to have a similar hands-off approach for what you do next year?
Yeah, the PGA Tour is a minority owner of our company, so they have no editorial control over what we do, but we have a great partnership, and our hope is that we can, take their assets and do really interesting stuff with it, like we did with Full Swing.
Talk about the audience that you're going for, because it's not just die-hard golfers. You're obviously trying to appeal to a broader audience.
Yeah, I think golf is having a moment in pop culture right now, and you see that. I mean, I think the rumors of Happy Gilmore or a sequel being made, things like Full Swing, obviously the rise of Instagram and YouTube golf. I mean, even the explosion of that kind of popularity. So our whole focus is really being at the intersection of golf and culture.
Yeah.
And you don't have to be a die-hard golf fan. If you just gone to Topgolf for the first time, you hit that first good shot, and you want to get more out of the sport, we're trying to create and serve that fan and bring the PGA Tour more into that world.
In building, though, a media operation around this at a time where the media landscape has changed a lot here, and obviously you had the partnership with Netflix, which is obviously the OG in streaming here. How do you envision it, though, long term? I mean, are you going to need to rely on a streaming platform, on a broadcast network, or maybe you'll just have your own standalone thing somewhere?
Yeah, I mean, we're definitely building out our own platforms. We now are owners of Scratch, which was a longtime PGA Tour sort of digital media focused online brand, which we're in the middle of re-envisioning and relaunching here at the end of Q4. We'll be continue to partner with Netflix on season 3 of Full Swing, which will be coming out at the beginning of next year. And we will partner with the PGA Tour on things like the Critter Classic at Eastlake that we did at the Tour Championship, which was live streamed on YouTube. So I think, it's a modern media ecosystem. You've got to be on every single platform.
Yeah.
I think what we're excited about is being able to take the assets that the PGA Tour has and all their great athletes and find new ways to do interesting stories with them.
And the content you're producing is centered around sports, and live sports is the main thing that's keeping legacy broadcast alive, as well as cable. Sports franchise valuations keep going up, and now we see institutional investors getting in as well. What do you think could slow the momentum of live sports, or at least, keep it from rising as quickly, and all the adjacent businesses like pro golf, pro shop? Do you think it's oversaturation? Do you think, we're one gambling scandal away from that?
I think I think Reed Hastings used to say this best at Netflix. It's their competition is just all the distractions around us. It's your phone, it's social media. Everything is kind of always on, extremely high velocity. And I think that, right now, live sports are the things that bring us together. It's like the last bit of our monoculture. But if you look at the most successful live sports leagues, think about the NFL, for example, and the ratings that it does. The NFL is an amazing package in terms of storytelling. It's tribal. You create fandom. You create superstars. And I think what golf needs to do, and what our hope is, what we were able to do with Full Swing, and our hope is what we want to do, we continue to do with Pro Shop, is find ways to bring people inside the minds of these athletes, create stars out of these players, drive interest beyond just the pro game, and just find ways to keep it relevant as we sort of, as the media landscape continues to fragment.
Well, on that last point, because that's what I'm curious about, do you envision that we are going to see more coverage from your platform of kind of up-and-coming golfers, maybe kind of the next big thing? Because I know for a lot of us, we watch this sport who've been fans of it, and, we're always kind of looking like, okay, who's really going to be the next king? Or queen, for that matter.
Yeah, well, I think brought up women's golf, a great example. Women's sports having an amazing moment right now. I think there's a lot of great stories to tell across all of golf, not just professional golf, by the way. We're not just focused on pro golf. We have unique rights and unique access to the PGA Tour and their assets. But in general, I think golf as a kind of cultural phenomenon has never been more relevant, and we're going to kind of cover top to bottom of it.
All right, Chad, great stuff here, and a really interesting project. Chad Mumm, he's the founder and president of Pro Shop Holding, and executive producer of that Netflix series, Full Swing. All right, when we come back after the break, we're going to take a look back at this day in history and a look back at the evolution of airplane food and the first ever in-flight airline meal. Scarlett, and here's a question for you before we go to break. Do you know what that first plate of food had on it?
I'm guessing it had meatloaf and a brownie. It's kind of like a TV dinner meal.
Is that what you're craving right now? All right, we'll get you the answer when we come back. This is Bloomberg. All right, while a lot of folks out there who fly complain about having to pay for food on airlines, but that pay-to-eat system was actually the original way that things were done. In fact, it was on this day, October 11th, all the way back in 1919, when a flight from London to Paris kicked off the trend of in-flight meals. The airline, operated by a company called Handley Page Transport, had its so-called cabin boys hand out lunches to the passengers on board, the first time a scheduled meal had been served in transit. But it wasn't free, costing each passenger what would be the equivalent of about $10 today. And what exactly did that milestone meal consist of? Well, Scarlett, get this. It was nothing fancy. Essentially, it was a box lunch that contained a cold sandwich, fruit, and a piece of chocolate. Now, initially, airlines saw such meals as a way to distract flyers from what at the time were incredibly bumpy, noisy, and uncomfortable flights. But as those planes grew in size and comfort, food and beverage service evolved as well. By the 1930s, United Airlines had installed onboard kitchens And by the end of World War II, white tablecloths and real silverware had become standard on first-class flights. By the 1950s and 60s, considered to be the golden era of air travel, even economy passengers were being plied with French wines, veal cutlets, and Boston cream pies, all followed by a complimentary after-dinner cigarette. Yeah, things were a little bit different back then. But those fancy-free offerings weren't done out of altruism. Airfares at the time were highly regulated, which meant a flight on Pan Am pretty much cost the same as one on TWA flying the same route. So the primary way the airlines could distinguish themselves was through those in-flight services. So over the decades, the airline meal, it would be reimagined and relaunched 100 times over, with food ranging from hot cuisine all the way down to vending machine. But the beginning of the end did come, and that began right around 1971, when a startup airline called Southwest found a way to get around airfare regulations and, well, chose to market its lower prices as, quote, peanut fares. And it decided to hand out, yeah, you guessed it, bags of peanuts instead of meals as a nod to that budget fare ethos. By 1978, the Airline Deregulation Act allowed all U.S. carriers to freely set their own fares, which created a race to the bottom to cut ticket prices and, as a result, cut operating costs. And that made those free and fancy meals an easy perk to nix, with airline executives betting that customers cared a lot more about a discounted ticket than a hot plate of food.
The original disruptor. And of course, we're focused on disruptors throughout this hour. I do want to bring you some breaking news here. Boeing coming out with preliminary results. It said that third quarter revenue of $17.8 billion misses the average analyst estimate of $18.58 billion. In addition, the preliminary loss for this past quarter is $9.97 a share. Boeing also announcing it is cutting its total workforce by roughly 10% and delaying the first delivery of the 777X program until 2026. And of course, all of this remain as that ongoing strike, which is now about a month old, is eating into its reserves. And certainly it already has the ratings companies threatening to downgrade Boeing to junk status.
Yeah, obviously a lot of this having to do, of course, with the strike as well. And we aren't actually scheduled to get Boeing's full earnings until October 23rd here. But again, that preliminary warning to investors, letting them know now to lower their expectations.
And Boeing shares lower in after-hours trading. All right, another, you were talking about airplane food earlier. Let's talk about baby food. Little Spoon is one of the largest online baby and kids food companies in the U.S., and it's on a mission to disrupt the $100 billion children's health and wellness market. Last month, Little Spoon became the first baby food maker in the country to publicly set EU-aligned safety standards for its products. I'm pleased to welcome co-founders Ben Lewis and Angela Vranich to the program. Welcome, guys.
Thank you. Great to be here.
Angela, I want to start with you because there's always an aha moment for an entrepreneur. And the aha moment for both of you started when you looked at the pet food market and you made a troubling realization that there are a lot of options out there in terms of fresh pet food, but not so much for parents of human kids.
Yes, exactly. Ben and I were both working in the food industry, and we're really seeing the shift toward fresh in every category. I mean, pet food was a glaring one. There were 10 fresh pet food brands, dressings, dip, juices, you name it. But baby food was this one glaring category that had yet to be disrupted. And we really wanted to set out to create a fresh alternative for parents to feed their kids. And that's how we came up with Little Spoon.
Right. Baby food is still sold in jars, with an expiration date that's usually years out. And what you've created is a way for parents to customize and create their own menu. How many different options are out there if you tallied it all up?
Yeah, so we have over 40 different options at Little Spoon. We source over 100 organic ingredients. We have a big focus toward palate expansion. So we incorporate interesting things like purple carrot, Japanese sweet potato, pitaya, things that parents may not be able to find in their local grocery store or don't necessarily feel comfortable incorporating in food they're making at home. So we really try to offer a wide variety. And we have wonderful seasonal offerings too. We just launched pumpkin spice, which is one of my personal favorites.
Do you do a lot of taste testing before this? Because when I hear expanding the palate, I just go back to the early days of being a parent, and it's I don't know. It's like there was one thing on the menu in our household for 2 years.
Yeah, we do a lot of taste testing with our customers. We do some focus groups, which are always really fun when you get a bunch of kids in a room and get their feedback. So we're constantly gathering consumer insights.
I am curious as to how you expand this business beyond. And Ben, maybe you could jump in here, because when we talk about this idea of scaling up a business like this, I mean, I'm sure it has to be a challenge, right? So explain to me how you what your thought process is, how you strategize that out as to how we're going to grow, where we're going to grow, and how fast it's going to be.
Yeah.
Yeah, so we started in 2017. We, as Angela talked about, our baby food, and when we saw the market, glaring opportunity, huge need. But really our vision was always way bigger than just baby food. We realized that there was a need in this space, but really broadly, as kids grow, there's not really a brand that can continue to serve their needs into the toddler stage and in, school age kids, right? So a big part of our growth strategy over the last several years has been growing up with the children, growing with the families. So fast forward to today, we have 7 different product categories across the baby stage, the toddler stage, and the bigger kid stage. So we offer meals, we offer snacks, smoothies, and a growing assortment of other products, more than 130 in total. So a lot of our growth has been just listening to our customers, kind of understanding where the gaps are, what their needs are, and then filling them with the best solution that we can create.
So Little Spoon goes to perhaps Medium Spoon and Big Spoon. Right now you're direct to consumer and to individual households. What about daycare facilities or hospitals and eventually school cafeterias?
So much opportunity out there. So as you said, we are an entirely direct-to-consumer business model. All of our business is on littlespoon.com, delivered straight to your door. We have a ton of interest from many other distribution outlets, whether that be daycares, whether that be schools, obviously traditional grocery is still a huge untapped opportunity. So we've been really focused. We've really tried to be focused in the way that we've grown the business and making sure we're serving the needs of the families that trust us to feed their children, but there's definitely no shortage of opportunity beyond that.
So Angela, how do you think about competition, whether it's upstarts like yourselves or whether it's the more traditional companies that have been doing this for a long time, say like a Gerber or any of the sort of the big food conglomerates?
I would say, we have competition in individual categories, but there's really no other company out there like Little Spoon that is offering a true one-stop shop solution for parents. So baby, toddler, big kid. We see parents typically coming to us when they're ready to start solids with their child, and they're staying with us all the way until that child is 4, 5, 6 years old, because we have offerings that can carry through with them as they age up.
How do you think about allergies and educating parents on how and when they introduce their kids to new ingredients, to different palates? As you mentioned, pitaya is going to be not troubling, but a challenge for some parents.
Yes, exactly. I mean, we get questions all the time from our customers. We're a direct-to-consumer business, so we have a one-to-one relationship with them, and we have a whole host of resources on our website to really help educate parents around introducing new ingredients, new ingredient exposure, allergen exposure, so really just offering that education where we can for parents.
And bringing in experts. I mean, we ourselves have developed expertise, but there's plenty of people out there, pediatricians, allergists, dietitians, and so on, that have real expertise in these areas. And so, our job is to make sure that our customers get the answers to their questions, whether they're questions we can answer, or whether we bring, folks to the table who have the expertise to.
Right, as opposed to letting them wonder about it on the internet.
Exactly, because there's so many questions. There's way more questions than answers, and so we just want to make parents' lives easier and just help them every step of the way.
All right, Ben Lewis and Angela Vranich, the co-founders of Little Spoon. Thank you so much.
Thank you for having us.
All right, let's take a look at how markets closed on the day. We finished with a 5th week of gains for U.S. stocks. For the S&P 500, it was another record high, the 45th record high so far this year. This time, it has been banks driving the force. 23 out of 24 names in the KBW Bank Index higher because JP Morgan and Wells Fargo kicked off earnings. Crude down marginally, I should say, but this has been kind of everywhere, and people are still very much on edge, waiting for news flow.
Actually, I'm waiting for that news flow, and they are getting it as earnings season really is going to start to pick up. We were expected to get Boeing earnings on October 23rd. They're out with that preliminary warning today here, saying that 3Q revenue will come in right around $17.8 billion, less than what the street was looking for, less than what they got it before. The other metrics there, whether you're talking about the GAAP loss per share, adjusted EPS loss per share, or charges, all coming in worse than expected. We'll be back in a moment. This is The Close from Bloomberg. As we continue our focus on The Close on entrepreneurship, we want to talk about Jadakiss, the Grammy-nominated rapper known for his catchy hooks and lyrical flow. Also comes from a family of coffee connoisseurs. He's expanded his business portfolio with Kiss Cafe Coffee. It's a premium coffee line of unique roasts and blends that spans 3 generations deep. I'm pleased to say that Jadakiss himself joins us right now, along with his father, Robert Phillips. And we should point out, your son is also involved in this venture as well. This is a family affair, right, Jada?
Yes, 3 generations. Just trying to do something different. You know, rappers get stereotyped or put in a box. They mostly do liquor brands or, you know, different endorsements like that. Like my dad likes to say, I have skin in the game as far as coffee goes. So we just took a shot at it, and here we are.
Bob, talk a little bit about this. Were you the influence on your son when it comes to coffee, or was he the influence on you?
I think it kind of worked both ways. That sort of swings both ways. I've been involved in the coffee business since the late 70s, early 80s. I worked for some of the largest coffee players in the country. I was employed by General Foods, Maxwell House for a lot of years. It's where I got my start. I worked on the commodity side, now still trading coffee, futures and derivatives. I worked for Louis Dreyfus Corporation for quite a few years. Fibro, I don't know if you guys remember that name. It was a division of Solomon. I worked with them for quite a few years on the trading side. So when I started my own business in 2004, and his career was just beginning to take off then. I think he had started, but he had started to achieve a certain measure of success around that time. And we saw all the other artists with the liquor and every hawk and every product that you could think about. And we thought it was a good idea since I had the connection with coffee. And we didn't, well, I don't think to date we haven't seen very much participation from the African American community in coffee, and we just felt that it was a natural fit that we do a product. And he bought it. I mean, I pitched it. It took him 10 years to make his decision, but
well, you weren't standing there with like a PowerPoint or something like that, John.
Sporadically, he mentioned it here and there.
But then you finally took the plunge. What was it that had you say, okay, let's move forward with this? What did you see out in the market that convinced you?
I don't even think I've seen anything in the market. I just think timing is everything with any kind of business endeavor you want to do, because he would mention it to me always for years. But I think something just felt right. Maybe it was the man above that said this was the time to, you know, put the play in motion, and then we did it.
Well, basically what happened was, I think the timing, like you said, all the stars lined up, but he had done a Versus. This is when we were locked down during the pandemic, and you couldn't be on stage together. And he had done a Versus, I think, with Fabulous. And
oh yeah, we all remember that.
Yeah, but I don't know if you remember that he was having a pretty good time. He had a bottle of Douce, and he was a little wobbly, and he was drinking, and and immediately after that episode, that Versus, people started to pirate merchandise in his name that he wasn't involved in. There were 4 or 5 companies selling Jada Drunk merchandise and doing quite well with it. And I think that, you know, I mean, he's my son, and I know it's his career, but I'm not from that genre, and really had no idea of how big his star power was at that time. But when I saw how well the merchandise was selling in such a short time, I think that sort of convinced him as well that maybe this is a time to do a legitimate project.
Well, Jada, I mean, about your star power, too, because, I mean, there are a lot of folks who maybe weren't necessarily involved in the coffee culture. I think a lot of times when we think about modern coffee culture, you got this image, you know, kind of some white hipster, you know, out in Seattle or somewhere. But, I mean, you bring a certain perspective, given your background, given being a Black American and being a rapper here. And I'm wondering, are the types of people buying your coffee, are these kind of new entrants into the space, or were they already you know?
I would say I meet throughout, you know, since we launched this business, has been very diverse, all type of ethnic backgrounds. You know, coffee's a individual, is a personal item that you consume the way you like to consume it. But it also, it's a very good conversational piece, it's a very good icebreaker, is a, you know, so.
And it's a product that's, you know, we didn't set out to develop a product. When we came up with the concept, I mean, since I had been involved in the commodity side and knew
through the
a certain
supply chain
measure,
at that.
I said, I'll do the production.
Yeah.
And you guys do all the marketing and social media and the whole thing. And we set out to make a coffee, not so much coffee for the coffee snobs as some people would have it, and that look down their nose if you put a pack of sugar in your coffee and it's got to be pure and this and that. Right. But we wanted to make a product that we felt reflected his persona. Coffee, everyday coffee, a good cup of coffee that you could drink every day without growing tired of it. I mean, he's recognized in the industry as been pretty accessible, a man of the people. I've never seen him refuse a photo for anybody, even when he was dog tired or whatever. He'd always go that extra mile and do the photo or the autograph. So we wanted to make a product, and we think this product reflects that, a product for an everyday guy. It's a premium product. Sure. We think it's a premium product. Could we make a better product?
Yeah.
That better is a relative term, but yeah, we could make a product.
How hard has it been to source the beans?
These beans are pretty much somewhat readily available in the market. I mean,
they're Arabica beans, right?
They're 100% Arabica, right? We're coming out with a line of products we hope to launch towards the new year. A line of gourmet, which is a little bit higher up the food chain, a collection of coffees, single origin coffees that we'll try to cater a little bit more to that upper end of the market. But this product we felt we wanted to do for the masses.
So Jadakiss, your dad clearly in charge of the production side, given his background. What do you handle? What does your son Joanne handle?
Since it's 3 generations, and you heard all the bulk of it. He really does everything, Mr. Coffee here. But my son is.
He had the money.
My son's the connection to the younger generation. Of course, me, social media. He does that. I'm like the face, and also somewhat the plug, somewhat the funder. I wear those hats over there, the little hats.
Yeah. You have this venture. You obviously you did the juice shops. You've had a few other things here. Are you still kind of looking for opportunities for kind of new business ventures beyond obviously just your music career?
Always looking to do good, diligent business, but right now my main focus is Kiss Cafe and Barcode. Those are the two. This is of course my baby, and that's like my new baby. So you got to take care of the babies.
All right. Well, we wish both of you luck here. And you mentioned last time we had you here, of course, we had that great discussion there with about Barcode, of course, the fitness drink there. This is Jadakiss, of course, the world famous rapper, along with his father, Robert Phillips, and of course they are the owners of Kiss Cafe.
Thank you.
We'll be back in a moment here, setting you up for what to watch over the next week. This is Bloomberg. All right, let's push ahead to what the markets are going to have their eye on over the next week. And we start off on Monday, and just a reminder, a U.S. holiday with the Columbus Indigenous Peoples Day. So the bond market is closed. The stock market is open. And so are the mouths of all the Fed speakers.
Yeah, there's a couple of Fed speakers on the calendar. Waller, Kashkari will be speaking. We'll look to them to kind of make sense of what we've been seeing in inflation data.
All right, let's flip to Tuesday here. We have quite a few things here, including more Fed speak from Daly and Kugler. And we also get some economic data and some earnings.
Yeah, Empire Manufacturing comes out at 8:30 a.m., but I'm paying attention to earnings out of Johnson & Johnson, Walgreens, but in particular Bank of America and Goldman Sachs after J.P. Morgan Chase came out with net interest income that surprised everyone to the upside.
Yeah, and keep in mind, too, in the world of politics, we've been promoting it already. A sit-down with former President Donald Trump also will be occurring on that day, on Wednesday. We're going to get NBA mortgage applications as well as import-export price index.
Yeah, so another way of looking at prices and the price pattern there. But Morgan Stanley and Alcoa will be reporting earnings. So earnings season really starts to get underway here as we broaden beyond the big banks.
Remember when Alcoa used to be like the first company, the first of the major companies to report, and it kind of lost that status a long time ago.
That was when the Dow mattered, too.
Yeah, yeah, right. Well, Alex still thinks it matters. All right,
sometimes.
Let's turn to Thursday, because we do actually have some really potential market-moving things, including a rate decision overseas.
Yeah, the ECB comes out with its rate decision. Of course, Christine Lagarde Lagarde will be then hosting a news conference there. They're looking to cut rates, and of course, they have to consider inflation. That is their single mandate. But here in the U.S., we get retail sales, so it's a read on the strength of the consumer and jobless claims. And after the close, Netflix kicks things off for big tech companies.
Yeah, that's going to be a big deal. And we also get some additional financial earnings in that morning. And then we flip to Friday here. Building permits is your main economic data point. And your favorite, Scarlett, more Fed speak.
More Fed speak, Kashkari and Waller. But also in the morning, we're going to hear from Procter & Gamble and American Express. American Express has been doing a really good job getting Gen Z interested in its cards.
Yeah, and I think it'll be interesting, too, to see when we talk about economic trends and whether they're seeing something different than what we heard out of some of the banks. We'll be back next week right here on The Close. Stick around. Balance of Power is up next.